Well, hello everyone, and hope you're all having a great Wednesday. This is Jean McDowell with TradersCoach.com, and welcome to Wednesday Night Live. And I'm going to go over a couple of little things before we do get started. First is, I'd love for you to find the questions area, the questions box in your GoToWebinar panel, and just type hello or type the name of the city that you're watching from. By doing that, that lets me know that yes, you can hear the audio and also you can see the webinar screen. And we love questions, so feel free to type in questions about Elliott Wave there, because Bennett will be fielding those questions and helping you see Elliott Wave in a new way and better than ever. All right, well, I've got folks saying hello from Hi JP from Michigan, and Thumper, you're here in California and LA, and yes, twice in one day. Thumper was in an earlier webinar today. So glad the audio is working and everything's good. So tonight's event is really exciting. It's going to be about Elliott Wave, the road map of the markets and the universe. And Bennett McDowell is an expert on Elliott Wave. He even wrote the book on Elliott Wave Technique Simplified. So Bennett, of course, is the founder of TradersCoach.com, and he's going to share with you a lot of terrific information about Elliott Wave with you tonight, and feel free to put your questions in the questions area. All right, Bennett, I'm going to turn it over to you.
All right, Jean, thanks so much. Hopefully everybody can hear me okay and see my screen. Welcome to Wednesday Night Live. We do these on the fourth Wednesday of every month. So it's great to have everybody here. Good turnout today. Thumper says twice in the same day, it's a miracle. This is my fifth one today, Thumper. What do you think about that? I had a couple coaching sessions today as well. So we've had our Wednesdays are pretty busy, but always good to get in front of the people, and love being with traders. So it's great again to be here. So tonight we're going to talk about the Elliott Wave, and it really, for me, is the roadmap of the markets. I really started using it. I've been doing this now for 30 years, and I started doing Elliott Wave, not exactly right at the time I started trading, but shortly thereafter. And it's really made a huge difference to me in terms of adding structure to analyze targets, what cycle we're in the markets, and it's great for short-term targets. So we're going to cover all that stuff today. And I'm going to also give you a couple quick clues on how to quickly determine the best points for drawing in fib extensions and retracements using the Elliott Wave. And when you use the Elliott Wave, you'll find that it becomes quite a bit easier, and the probabilities increase on the target zone. So we'll talk a little bit about that. So we've got a lot to cover here, but we will be here for about a half an hour. All right, so I try to keep them just long enough to keep you interested, but not too long enough to make you yawn, that type of thing. All right, we got to talk about the risks too. I can't do one of these without talking first about the risks involved in trading. And there are risks both in investing as well as in short-term trading the financial markets. So no free lunch out there. You got to risk a little to make some, right? And that's certainly true in the markets. And past performance doesn't guarantee future performance. And also too, we're going to talk a lot maybe about specifics. Run those by your financial advisor to be sure they're suitable for you, because we don't know your personal situation, they do. And then of course, my recommendation is always to use money you can afford to risk, called risk capital, when you're actively trading the markets, and also know how to do risk control. And we can help you with that, because we've been doing this again for quite some time. We used to do help traders back in this topic area in 1999. We ran a lot of trading situations at the trading expos. I traded the live trading challenges quite often, and we usually had quite a big booth at the expos as well. And then pretty much everything moved online. So now we do, most of our work now is done on the webinars. And then we have a bunch of books available. We have a great book on money management on the far right, only because it's so concise that it gives you exactly what you need without having, you know, a book that's 2 inches thick. So that's a great book for you. My new Art of Trading book is second edition is coming out in this year. And my publisher, Wiley, asked me last year to put that together. So we're almost done with that. And then I've got, of course, the book on Elliott Wave Technique Simplified. and the Trader's Money Management System, which is a more comprehensive book, and the Survival Guide for Traders. All right, so when we talk about the Elliott Wave, I want to give you a little bit of history and specifics about it. So I want to start out talking about Ralph Nelson Elliott. And this goes back quite a bit in time. He was born in 1871 and actually was an accountant. And back in 1929, he almost died. And he was basically in a hospital recuperating. And he turned to the financial markets at that point. So really, he was an accountant before, okay, became ill, needed something to do. And I guess he got involved with looking at charts on the market. But he studied the stock market, and it's certainly not as many stocks as we have today back then, and studied the Dow theory. And basically in 1938, he wrote a pretty interesting book called The Wave Principle. And his final work was called Nature's Law, published in 1946. And that came out about 2 years before he passed away in 1948. One of the interesting things about what he had found, and don't forget, back then they didn't have computerized charts. He had to look at paper charts. And so what he found is that in the markets, when markets trended either up or down, there were patterns that he identified. And basically, we're going to talk about the patterns identified, but basically on an Elliott wave, there were 5 sequential waves in a trend, followed by usually a change in the trend. And so he studied that some more and came up with a variety of mathematical numbers of how long waves should be and so forth. So we call that kind of the classical approach because it was classic Elliott, all right? He didn't have computers. He didn't have some of the indicators that we use today that help us verify those counts. And we're going to go over those today as well. But quite an interesting situation. And I think the main thing to take apart from that is that it was an observation. He didn't create the Elliott wave. He basically observed these patterns, and therefore his discovery was known as the Elliott wave. Kind of like, you see a black hole up there, the astronomers see one of those, and they really don't know exactly how it functions, but they know when matter gets close, it gets sucked in and it's gone. And that's an observational type of situation. They didn't create it, but they observed it. And so the same type of thing is exactly what Elliott did with the financial markets, but specifically back then, of course, the stock market. All right, then that leads us to current day, or even back then, of why bother with it. And one of the reasons is it's because it's an excellent tool to tell you what market cycle you are in. Are you in a bullish trend, bearish trend? Is the pullback that you're in now part of the ongoing trend, or is it something more significant? These are all questions that the Elliott wave can answer. It's also basically looked at in terms of making a profit, because obviously if we know basically through Fibonacci extensions and retracements of target zones and so forth, we can formulate a profit scenario from that. It encompasses mass psychology into technical analysis. A lot of the Elliott wave is, well, it's all mass psychology, because what happens is you have movements in the market based off greed and fear. Markets get extended, and when they get extended, people fear, so they start taking profits. The market comes down, the people that couldn't get in before maybe want to go in now, so the greed kicks in to get in, all right, and then the whole thing starts again. So it's that pull and push of the market constantly that we see that develops, or it processes, the mass psychology of fear and greed. Kind of interesting stuff. And once you actually know your target zones and you know key pivot points in the market through these wave counts, you can know where to put your stops, you know where your profits are, and that of course leads to the risk and reward expectation calculations. So once you kind of understand what the Elliott wave is and how to use it, it really becomes a roadmap of the overall market on the time frame you're looking at. And there are many different time frames of a market. And for those of you new here, normally when you look at a chart, you're looking at a daily chart where every price bar represents a full day. But for example, a day trader may look at a very, very short-term time frame, maybe a minute time frame or a 5-minute time frame, or maybe a tick chart. But if you can read the data, for the most part, there is an Elliott wave count unique to that particular market. So it's kind of interesting. So it really becomes the roadmap of the market, regardless of the market or the time frame you are looking at. All right, just a little basics we'll cover here on what is the Elliott wave. Again, it's a form of technical analysis. It's not fundamental analysis. But I will say what's interesting about the Elliott wave is in a bullish trend, the markets tend to ignore bad news and accentuate good news. And so the market goes higher and even gets manic. On a downtrend, the opposite occurs. So in a way, it's not fundamental analysis, but in a way, certain news events can play into it. Let's just say that. All right, so the wave principle states that collective investor psychology or crowd psychology moves from these moods of optimism and pessimism and back again. And you, of course, can see that in the profit, okay, taking in a market, as well as the greed of getting into the market. That psychology moves. And of course, these swings create patterns, price patterns, as evidenced in price movements of the market. And basically, I'll show you on the Elliott wave in just a short period of time about how these movements occur in waves of 5. So it's kind of very interesting to see that. All right, now, when Elliott was involved in looking at charts, we call that, or tend to call that, the classic Elliott wave approach. And that is basically focusing on the price and the mathematics around price. You know, what's the mathematics around price? Well, it is a combination of, like, if wave 1 is a certain distance and wave 3 is probably going to be at least the same distance, if not 1.62 higher than that, things like that. So there's math behind the Elliott wave for the most part. And there's also counting the waves inside the waves, and all that is part of classic Elliott wave approach. The modern Elliott wave theory brings into the help of computers, looking at things like momentum that can be easily measured by computers in real time. So all that kind of stuff adds to the credence of an Elliott wave count. For example, we know we have the highest momentum in wave 3 of the 5 waves in an Elliott wave. Computers can quickly identify that for us. And it really also identifies the fact that these patterns repeat on all time frames in all markets. So let's dive into a little bit more on price and see exactly what Elliott was looking at. And if you guys have any questions why we're doing this, feel free to ask, okay? And I'll get to those as soon as possible. But I think you'll find this kind of interesting because we cover a wide variety of topics on this. So when we look at an Elliott wave, all right, think of a market like this. I mean, if you didn't have all these numbers here, it would basically kind of look kind of zigzaggy, all right, like this, all right, and kind of haphazard and chaos-like. But when we take a look at the structure of the market, the first peak up is your wave 1. Your second peak down, provided it doesn't go up below its starting point here, which technically we can call that a 0. If it stays above that and then markets get above 1 again, chances are you're in a wave 3 of some degree. All right, and then after wave 3, you get a pullback on wave 4, and then you get another surge forward with a new high above wave 3 called wave 5, and then the trend usually tops there and ends, and then adjusts or corrects in a more significant way. Now, one of the interesting things that he noticed during all these types of things is that there were also little patterns inside the different movements. So this movement from here to here, called wave 1, is what Elliott called an impulsive wave. And impulsive waves always move in the direction of the major wave count. So obviously this is a 1, 2, 3, 4, 5 with 5 ending higher than 1. So this is a bullish trend. And so any movement up towards the trend is an impulsive wave. So we have 2 here, 3 is an impulsive wave, and 4 to 5 is impulsive waves. Now, notice what you see inside this. Every time you have an impulsive wave, there's 5 smaller waves inside it. And this is the kind of stuff that he basically observed happening more often than not. And when it's clear, it's really clear. And then also he noticed during the profit-taking phases that you usually had an ABC correction. Sometimes they go into a more complex correction, and we'll talk a little bit about that. But for the most part, we assume usually it's an ABC correction, and then another impulsive wave with 5 waves in it, another ABC correction, and ends the 5th wave with 5 waves in it as well. So that's what he noticed looking at repetitive charts on different markets over the years that he was recuperating during his illness. Now, if we apply this to an actual chart, it becomes even more easy to comprehend. And here is Apple stock, not recently, but a little while back, maybe a year or so back. And basically, this gives you a perfect depiction of the Elliott wave in action on an actual chart, not a drawing. And that's what is so significant, I think, about this. So our move off here, okay, was a 1, 2, 3, 4, 5. So there's your big impulsive wave up with the 5 waves inside it. Here's your ABC correction, wave 2. And then our biggest move up on Apple stock, wave 3. And again, if we look close enough, we can see the waves inside the impulsive wave. And then we have the ABC correction. And then again, we get that final push up with 5 waves. And of course, look what happened. The trend ended and boom, down it comes. And it created a new trend down. Now, the other thing that's kind of interesting is about this particular chart. This happens to be a daily chart. But if you have a hard time seeing these little waves inside waves and you want to, then you can go to a lower time frame and they maybe become more clearer. So the smaller waves are easily seen if you go and drop down, let's say from a daily to a 60-minute time frame, you can see those. So now again, when we talk about fibs, drawing fibs in, all right, normally we anchor those at specific levels. And in an Elliott wave, for example, when we look for a wave 4, we usually anchor them on wave 2 and wave 3. Now, that may be a little bit different than how you have learned to do retracements or fibs before. A lot of times, I think if you Google fib retracements, they'll tell you to anchor it at the start of the trend, which we'll call 0. So they would anchor it here and here. What we have found, why we like to use 2, is what we have found is when we use 2 to 3, the 31.8 retracement and the 61.2 retracement yield a 70% probability zone. So it gives us a nice target to look at for the retracements. And so that's why we like to anchor those fibs off wave 2 and wave 3. All right. Now, when you're about to draw in a fib here, notice that you're obviously not going to draw it in here. You're going to wait until things start to perk up and you can easily identify a 3. So you're not going to know the wave 4 area until you look at a market that's either about to go into wave 4 or has broken down and gone below some key levels of support where you're pretty confident wave 3 is over. And then you're going to draw those 2 in to give you the wave 4 target zone. Now, sometimes you can trade that. Sometimes people don't. They wait for it to get to wave 4 and then go long again. Okay, you can certainly do that as well. One last thing to do is what gives people a lot of hard times is how do you find wave 2? Well, a real clear way to find it, it's usually the first major pullback, all right, after the movement off. So when you have this move up here, don't forget, you're going to be able to see the history all the way up here. So you're going to see this as being the lowest low after it takes off from point 0. That's your wave 2. Okay, so that's how we identify it. And then the target zone for wave 5 can be achieved through a fib extension by anchoring it on wave 2, 3, and 4, because it takes 3 anchoring points for a fib extension. Okay, so that's kind of the synopsis on how to draw fibs using the Elliott wave, and we have found it to be a very, very good way of doing it because I personally love those 70% probability zones. Drawing it in that way basically creates, okay? So it's really good to know with high probability if a wave 4 is finished, because if it's in that target zone and then you start to bounce off the bottom, all right, then you have a good probability of knowing that. And of course, those people using our software, we also measure the momentum, and that also helps us know when Elliott wave 3 is a 3 and when we get the momentum turning around here for the end of wave 4, and likewise the momentum down after wave 3. But what I love about this example is it's real. All right, this is taken off a real chart, so it's kind of cool. Now, just a quick little thing I want to cover is the different degrees of Elliott wave. This kind of goes with what I was talking a little bit about before, about being able to see waves within inside waves on lower time frames, but it also applies to higher time frames. So, for example, at the end of a 5-wave move here, all right, that may be part of a larger move on a larger time frame here. Okay, and then after 5 waves, you get a major ABC correction, and that's wave 2, and then you get a big push up here. So all these little waves inside here correspond to a bigger picture. And then notice even here, okay, this little wave here can correspond to the beginning of something much more dramatic. So that's why when we do Elliott wave, we like to look at the long-term time frames to get kind of a clue of where we are in the big roadmap, and then go backwards from there, or you can go from where you are now forward to see where you fit in to the larger scheme of things. So you can't really talk about Elliott wave with not at least mentioning that. All right, you could spend a whole course on just talking about this. All right, next thing to quickly address here are the pullback or corrections or profit taking areas in a market. And this occurs during waves 2 and wave 4. And this is kind of an interesting topic, and it takes a little time to sink in, because we talked about the trend here being up, the impulsive waves being 1, 3, and 5, but also 2, check this out. So you got an ABC correction in this example down to wave 2, but wave 2, then after wave 1, is a move down, and then the subwaves inside the move down become the impulsive waves moving towards the correction. So in this case, wave A and B are technically impulsive waves, and one of the rules of Elliott is that any impulsive wave can have 5 waves in it. Now you might not see it that clearly on the time frame you're looking at, so you may have to go even lower to a lower time frame to see it. But there usually are 5 waves inside these type of waves. So we see that quite a bit too. So that all can come into play, just to kind of want to mention it, that anytime you have an impulsive wave, whether it's bullish or part of a correction, there are 5 waves inside that. Now, I just want to go back one quick second to the actual chart on Apple for a minute. And one of the things that is impressive about this is if you show up on wave 3 and you think you have a wave 3 here, all right, what you could do is you could figure out where the top of this is by doing a fib extension off the inside waves to get the target of wave 5 inside wave 3 to have a more precise target of where wave 3 should end. And you can do that on any impulsive wave at all, because impulsive waves are made up of 5 waves. So you can do your fib targets, both extensions and retracements. And so you can do them on the waves inside the waves to figure out where the completions are going to be on the waves that they represent. So I kind of just want to mention that, because that's kind of a cool aspect people overlook, I think, a lot. All right, so I just want to go over quickly some, you have bearish and bullish corrections depending on the trend. And that one we looked at, called an ABC, is basically considered a zigzag corrective pattern. Okay, zigzag corrective pattern. You have a triangular complex correction. So sometimes you'll see pennants. How many people have seen pennants in the market? Okay, good. Oh, quite a few, of course, right? Well, pennants are pretty powerful, because when they break from that pennant, it can be pretty significant move in that direction. But pennants really 9 times out of 10 represent an Elliott wave corrective pattern that's complex. and it's usually called a triangular complex correction. So that can develop into an A, B, C, D, E type of situation, all right, where the market gets compressed and then breaks out. You always consider beforehand that it's going to be a simple ABC correction, and then if it proves to be more complex, then you know what to do by adding in the additional wave counts. And then, of course, you just have a simple flat complex correction, a channeling market, for example. An irregular, kind of similar to a pennant, but kind of the other way. All right, instead of compressing down, it compresses up. And you have bullish and bearish representations of that as well. All right, so now, even using price, okay, there's some criticism of the Elliott wave in that many feel it is subjective. And it's usually subjective because, A, they don't realize that there are waves inside waves that can add to the confidence level of where a wave will end, for example. But there's also, there's some math involved in that, and there's the knowing of how to properly draw your fib retracements and extensions. But also too, with the goal of basically taking the subjectivity out of the wave count, we bring in the modern approach to the Elliott wave analysis. And this is kind of where we like to kind of start connecting the dots to formulate a probability on the forecast. And so, and I call this connecting the dots. So again, we've been doing this for quite some time. So we have found that these dots are really quite significant. And so whenever you're looking at an Elliott wave, you want to take into a variety of factors. One, you do want to take a look at the classical approach. You got to look at price. You got to see if the slope of a wave 3 is indeed a much more manic, vertical, significant slope than the others waves in the trend, because that's your wave 3. You want to use Fibonacci price levels. So if you have retracements like a wave 4, they have to hit the right high probability retracement levels. 70% of the time they hit those. All right. We use something called the owl histogram to take a look at our momentum for us to indicate the help in confirming a wave 3 as the highest momentum and the highest volume on wave 3. We also use something called the PTF to help us determine if some of the impulsive waves are over, especially wave 3 and wave 5. Basically, we look at the fractal nature of the Elliott wave, and that's a combination of looking at some of the indicators, but also too, fractals are the movements inside the major wave. So it's those smaller waves inside. Those are also fractal patterns or new waves. Volume, like I said, and if we see price compression channels or pennants in the market, those occur during usually waves 2 and 4. All right, so we kind of keep our eyes open for that. And then we assign percentages to each one of these types of dots we connect. And then we take a look at our risk control for entries and exits. Now, it's really important when you think about the Elliott wave, I have something called grounded versus ungrounded assessment. Anytime you're forecasting the market, I call that an ungrounded assessment because it's based on a theory. It's not really fact. It's a theory that works in probabilities. It works more often than not. But you always have to have your risk control based on the grounded assessments. In other words, how much you're going to lose if you're wrong, how much you're going to win if you're right, where should your stop be placed, and so forth. So that's reality, okay? That's where you need to ground your forecast. So if you're wrong or the wave count is not, because sometimes you have two alternate wave counts. So if you happen to pick the wrong one, then you're going to be stopped out. You want to make sure your grounded assessments keep your losses small. That way you let your winners run, okay? So grounded versus ungrounded assessments come really under the category of risk control, trade entries, and exits. All right, so we have a course, and I'll get to that in a little bit, where we go over talking about what makes up the probability matrix of the percentages of clarity in the Elliott wave. Before I do that, I want to just give you some examples of what we've actually used the Elliott wave for in the past. Now, this happened to be a stock that we were in here, and notice we're going to just really make this simple. So we started here with a wave 3. All right, then we had our ABC correction, wave 4, It hit the fib retracement area here between 38.2 and 61.8. 70% of the time that happens. You always have negative momentum during the profit-taking stage of wave 4 because it is a major profit-taking wave. And then when wave 5 starts back, all right, the momentum shifts back to the upside, but the momentum on the next wave up never exceeds the momentum in wave 3. So wave 3 always has the highest momentum. Therefore, you always have bearish divergence between wave 3 and 5. If by chance wave 5 ends up having a higher owl or momentum than wave 3, then that becomes your new wave 3. All right. So that's kind of how we do it. But notice here we hit here the target. Target is 61.8 to 100%, 70% probability on the way we anchor and target our extended wave 5s. And then we had, of course, the sell-off, which was expected after wave 5 and all the indicators, including momentum, turning bearish. So that's one example, but that's a bullish example turning into a bearish example. And then here is a bearish Elliott wave. So here's your wave 2 here, your wave 1 here. All right, then your big move here, 3. Then your 4, and then 5 with the target zone here. Okay, this indicator says here wave 5 is not over. Momentum is still pretty strong, not above 3. So it should end somewhere in that 61.8 to 100% target zone. So again, we don't have the owl colored here, but this would be a red owl here. This is your green owl that has to be green during a wave 4 on a bearish trend. And then wave 5, the owl goes back to the red or bearish owl. And so that would be a downtrend. Here's another one, here's another one up here on another stock a while back. And this kind of brings everything into clarity as well. Your wave 1, your wave 2, your 3, your ABC correction, waves inside the waves for wave 3, your negative owl, and wave 5. And so these are the kind of dots that we want to connect in order to have a good forecast. Now, if you're going to be trading wave 5, let's say you show up and it's a wave 4 correction, you want to see a red owl. You still want to be able to connect these dots and then connect the target to see if there's enough target potential after the wave 4 target, and if you can get in early enough to take advantage of that. So that's doesn't matter when you show up on the Elliott wave. The most important thing is to know where you are in it, and then from there you can determine if it's tradable, if there's a tradable opportunity, okay, something of that nature. Now, if you show up here and you're just coming above wave 2, well, that's a entry pattern of an uptrend here, and you know, that's an early entry after a possible significant bottom. So you need to look probably at the history on the left side of this chart, which we can't see, and see what kind of pattern was there before we began this new movement. Maybe we had 5 waves down on the left side before we got this movement. Maybe we had a bracketed or channeled market for quite some time and a push out of that for a new beginning of a big trend. In any case, if you get the breakout, watch the pullback, and then prices get above wave 1, then basically any technical analysis type of trading system is going to put you long. And then as wave 3 develops, you'll see it. Here's one on a downtrend here. Okay, same type of thing. Our software, which you may or may not have, would put you in here. But again, here's your Elliott wave counts: 3, 4, 5, bullish divergence, staying short because one of our indicators are indicating wave 5 is not over. So the point here is whether it's a bullish trend or it is a bearish trend, there are Elliott waves on all dimensions of the market. This is a forecast that I was actually pretty well known for back in the year 2000. I was at Morgan Stanley, and at that particular point in the late 1990s, the dot-com bubble was taking off, and then we had a break in it. And as soon as we took out this support here, okay, we called for a bottom of around 7,500 in the markets. It actually got down to 7,300 before it rebounded. And all that was based off was a normal 61 to 38% fib retracement after a wave 3 indicating wave 4. And then sure enough, after that, the markets recovered and made new highs. This was during quite an interesting period here because, again, this was the late 1990s where my arrow is here. We had the dot-com bubble burst here. That was the initial A wave down. Then we had a rally off that, and then we had 9/11 bringing it right down to the target zone. And that happens a lot in the Elliott wave. A lot of times things come out of left field. You don't anticipate where these levels are certainly reached. So kind of interesting nonetheless. All right, let me just, I see a lot of questions came in. So let me just take a look at those now. This is a good place to take a look at those. All right, let's see what's going on here. Thumper's asking, does Elliott wave work on volume charts? Don, that's a great question. If you can see the price waves, if you see waves in a market, regardless if it's volume charts, tick charts, so forth, then the Elliott wave is there, okay? It's not something that's hidden necessarily. It'll be there for you, okay? You'll be able to see that. Good question though. All right, let's see, Thumper's asking, does the software do 1 month, 1 year, 5 year? Are they done on 3 different charts or screens? Yeah, if you're gonna take a look at, for example, a 1 month Elliott wave, you need to bring up the 1 month chart and then go ahead and apply like the owl on there, Thumper, for wave 3 and do your, both your modern and classical approach on that 1 month chart. And then you do the same for the year chart and a 5-year chart. So basically you just bring up the chart you want to look at, and that's how you can put it together. Another good question. All right, how low can wave 4 go? Lee is asking. Wave 4 can go pretty low, but not lower than the top of wave 1. So that's generally one of the classic rules of Elliott wave, that you can have a deeper wave 4, but it cannot go below the top of wave 1. Now, I will tell you, the deeper the wave 4, the lower the wave 5 target zone is going to be. Sometimes when you get a shallow retracement, you'll get a higher wave 5, okay, just so you know. And so that happens. All right, is wave 3 regular 45-degree angle? It's different. There's no real degrees it has to be. There's no rule behind that. The only rule, I think, from a visual standpoint is when you look at a chart and you see a big move up like Microsoft, Amazon, okay, Amazon's might have just completed a wave 4 retracement as well as Microsoft, but you can see before that retracement came up how large that move was, and that's a wave 3. So wave 3s pretty much pop out at you. When you look at a chart and it's very messy, chances are you're looking at a complex correction that's been elongated. So if you kind of got to scratch your head a lot to see what you're looking at, chances are you're in a correction. But when you see a wave 3, you can't miss it. It stands out. And the interesting thing about a wave 3 is there's so much enthusiasm in that wave that it basically gets very manic too at the end. But then when it goes into the correction, and after the correction, wave 4 is over and wave 5 comes, what's very interesting is wave 5 gets higher than wave 3, but the enthusiasm is not near what it is on wave 3. So it's sometimes a very meandering wave, or you kind of all of a sudden, wave 4 was so dramatic that by the time you look and see what's going on with wave 5, you can't believe it's almost approaching the top of wave 3. So it's kind of one of those waves that kind of just meanders and gets on top, and you kind of scratch your head and wonder why sometimes. But that is classic wave 5. All right, let's see what else we got here. Mike is asking, we look for what may be wave 1 and then anticipate wave 3 after the wave 2 pullback. Correct, okay? And again, let me just put up a little whiteboard here real quick. So one of the things I think, again, is one of the hardest things is when you have this first move up, okay? This is an impulsive wave, wave 1, okay? Now, the second move down, wave 2, can actually almost go to the bottom, or actually can go to the bottom. It cannot go past 0, the start point. but it can come down, almost form a double bottom and move its way back up. And so when it gets above wave 1, all right, then now you're trending up. And then you want to be long there, because no matter how you look at it, this could be a major bottom. Right now, you may not know exactly, but you want to be there. And as this moves up, if it moves up very, very strong, then you know that's obviously a wave 3. And you'll probably have a pretty good idea here that it's significant. Here, okay, the herd jumps in, and then here it's in the news, and by then it's profit taking time. Okay, and that's what happens with that. So again, the easiest way to find wave 2, it's always the deepest correction, all right, based off the move, the beginning of the trend. Okay, that's the easiest way to find it. So when you draw your fibs, remember that. All right, let's take a look here. Kumar, yes, Tesla and NVIDIA, perfect examples of Elliott Wave 3. Absolutely. And also too, if you come Friday, we do on YouTube live market analysis on Fridays, and we take a look at Tesla and NVIDIA and things like that. But yeah, NVIDIA is looking real good. All right, and Tesla too, so good job on that. Why does 5 become the new wave 3 if it has higher momentum? Excellent question. I don't think the Elliott wave, I don't think that's an Elliott wave 3 wave rule. Why can't just 5 occasionally have a higher momentum? Well, because wave 3, one of the rules on Elliott wave is that volume and momentum have to be the highest on wave 3. So if wave 3 looks pretty good, but then we see a correction, and then we have a new move up, then that new move, we think it's a wave 5, but it has higher volume and higher momentum, that's still considered all part of wave 3 at that point. Okay, so then you're still in wave 3. So there is a rule that basically the highest volume and highest momentum are on wave 3. All right, let's see, Don, let's see. Why does the wave 3 text disappear sometime in wave 3? Now, when you say wave 3 text, do you mean in the owl? Not sure exactly what you're referring to. I think you might mean that. Okay, so sometimes the wave 3 text will disappear on the art software. Let me just go back here a little bit on some of the slides so I can show people what you kind of mean here. All right, so what he's kind of saying is this type of thing. So you see how it says wave 3 here? So what we do when we actually are looking for wave 3, we have what we call a extended look at the market, and we also look at the current degree of the market. Now, our software on the owl goes back 144 price bars and tries to find the owl within the last 144 price bars. And also, Don, you might want to read the software manual on the owl, because we address this as well there. I'll give you a little more insight into that. But when we go back 144 price bars, we're trying to give you the current wave 3 on the current cycle you're in. However, sometimes, this could be a wave 3 inside a C wave on a correction, for example. And if you'll notice on the software, we have an extended wave view checkbox. And if you check that box, then it will find the biggest owl on the history that you have on your chart. And that's when it will detect possibly a different wave 3 representing the major wave 3. All right. So, that's a little complicated in terms of explaining that without having the software up and running, but that's kind of the realm behind it. If you come to the client support next week, I'll be glad to show you that. But yeah, so that's it. So again, in this example, if this moved down and created a bigger owl here, then this would be a minor wave for inside a major 3 instead of a 5. Okay, so that's kind of how that's looking at it. All right, so let me just see. Boy, a lot of questions coming. This is great. All right, so I think I got them all. Google, I'm sure. Yeah, we're seeing a lot of the wave 4 majors on the weekly chart ending. So it's kind of interesting. All right, let me see. A lot of people, let me see. Oh, anyway, okay. All right, let me just keep going here. All right, I think I've got them. I think I got it. So again, Don, I don't think I fully answered your question though. So when you have more than 144 price bars, so when this moves further here, this will disappear and be replaced by the new wave 3. So I think that's maybe what you're asking, okay? And also too, depending on the color background of your chart, make sure you have the text set to what you can read, okay? The color, the text color. All right, let's see. How long can wave 4 go? Well, that's a very good question. Now, there are fib time extensions that you could help to answer that question. I don't use them that much. What I tend to do more is focus on the ABC correction, or if it goes into a complex correction, chances, if it's an ABC and goes into a complex, then E wave will replace C wave. So I should be able to see 5 waves in E wave. And so therefore, at the end of the 5th wave, then I'll know wave 4 is over, whether it's C wave or E wave at that point. But complex corrections can go on a lot for longer than you think. Okay, there's no real precise time number. I've seen them get extended for the most part, and sometimes, but not usually. Usually they're ABCs, and they usually are, I'll say, a third of the distance of third of the time of a wave 3, and that's just a visual observation. But I really don't go by that, because I usually I look for a wave 4 to complete when it's in the target zone and I see the momentum changing. Well, you guys, great questions here. Yeah, so divergence on wave 5, always. Okay, I think I got that one. All right, Thumper, the manual in the OWL is included in your software download folder. So probably it's in your documents folder, and it's in the art installation folder, okay? Now, if you don't have it, you can go back into the VIP area and go to the NinjaTrader download area and just re-download it, and they're all in there. My pleasure. Okay. Boy, I think I got them all. You guys did great. All right, so what do you think? Gonna try the Elliott wave? I would definitely check it out. Again, you know, I've been doing this a long time, and so it's really an outstanding tool to really give you an idea. Now, if you want to take a deeper dive into this, all right, I have a great home study course available, and we have a webinar special that Jean priced for this at $373. So she'll put that link up in the chat area if you want to explore that. But that will also, there's homework, there's all sorts of good stuff in there. And that will really get you honed up on being able to be proficient in counting Elliott waves, and also use them for your trading, of course. Don's asking, is the PTF good for knowing the end of a wave? It can help, all right? It's not always the end all, so to speak. For example, you can have a wave 5 and the PTF may be neutral. All right, so again, if a wave 5 is sitting in the target zone and you can see the 5 waves inside the wave 5 and the PTF is yellow, then the chances are pretty good that wave 5 is over. However, if you see the 5 waves in a wave 5 and you're in the target zone, and the PTF is signaling more highs, for example, in a bullish Elliott wave 5, then chances are the 5th wave inside wave 5 is not over. Okay, so hopefully that helps. All right, good, Lee. Excellent. Glad you liked it. Well, we try to make these things worthwhile. Okay, so the idea is we try to, always teach you something on the Wednesday Night Lives. Sometimes we cover risk control. Today we cover Elliott wave, and so we usually have a different topic altogether on depending, alternate it from month to month. So good, glad you enjoyed it.
Great
All right,
group
well, I
tonight.
guess, Gene, I will turn it back over to you. I want to thank everybody for being here. I think, Gene, if you want to talk a little bit more about the course and the link you put up there, it's all yours.
Excellent, excellent. Well, everybody, this was a great session, great questions, and I encourage you to click on that link because if you want to learn how to count Elliott waves, Bennett is the man to help you. And the more you hang out with him, the more you're going to just be able to read them easily. So very exciting. Lee's saying, Lee says, I already have the course. Good for you, Lee. And you want the link to the course. The course, Lee, is in your VIP membership area. And I can certainly get on the phone with you and help you access that if you need help. So if you like, I can give you a buzz tomorrow. Would that work for you? Excellent. Okay, super. So actually, Lee brings up a good point. When you do buy the course, you own it for life and you have 24/7 access to it in your VIP membership area. And the course is extremely thorough. It's got videos and homework and workbooks. But I think one of the best features is that you also get to come every single Wednesday for client support, and you get to talk to Bennett every Wednesday about Elliott Wave, just like you're asking him questions today. So does anybody else have any other questions? Great, great, super. Okay, well, Bennett, I think that's it. And I think we'll wrap it up for this month's Wednesday Night Live. Great to see everybody here, lots of friendly faces. And we'll see you next month on the 4th Wednesday of the month for Wednesday Night Live. Have a great night, everybody.
Gene, thank you, and thank you for putting it together, and great to have a good turnout. Thank you, everybody, for coming. Have a great month, and we'll see you next month.